Hi everyone and welcome back to the channel. Today we are going to analyze ServiceNow, one of the leading enterprise software companies in the world. We'll look at what the company does and why its stock price has declined from January 2025 to the recent low in April 2026, and whether the concerns surrounding AI and increased competition are justified. We'll also explore the bull case, including the company's strong subscription growth, impressive customer retention, and its position within the rapidly growing AI ecosystem. Finally, we'll discuss the valuation, the key risks investors should consider, and why some long-term investors continue to dollar cost average into the stock despite the recent pullback. So, if you are interested in understanding whether ServiceNow could be an attractive long-term investment opportunity, stay tuned and let's dive in. So, first things first, ServiceNow is a centralized platform that helps organizations automate daily operations across multiple departments, including IT, human resources, finance, and customer service. Today, the company serves nearly 9,000 customers worldwide and maintains an impressive 96% renewal rate. This highlights the strength of its business model and the stickiness of its revenue. Once a company integrates ServiceNow into its workflows, switching to another provider can be costly, time consuming, and operationally disruptive. So, why has the stock declined? There are several reasons behind the weakness in ServiceNow's share price. First, investors are concerned about the rise of independent AI agents. The market narrative the market narrative suggests that powerful general purpose AI systems such as Claude and other AI assistants could enable companies to build their own internal automation tools, potentially reducing the need for specialized software subscriptions. Second, ServiceNow has spent roughly between 10 and 11 billion dollars on acquisitions in recent years. While these deals may strengthen the platform over the long term, some investors question whether the company can continue expanding its market share organically without relying heavily on acquisitions. Third, the company is experiencing temporary margin pressure. This comes from acquisition related costs, integration expenses, and broader uncertainty surrounding US government contracts, shutdowns, and budget instability. For the dollar cost averaging thesis, we can say that despite the stock price decline, many investors continue to accumulating shares. Why? Because in the most recent quarters, subscriptions revenue grew approximately 22%, demonstrating that the business continues to execute well and expand its customer base. Additionally, AI adoption across industries continues to accelerate. As companies increase spending on AI powered solutions, ServiceNow is well positioned to benefit because many of its customers are investing heavily in digital transformation and workflow automation. Industry-wide AI spending has surged by roughly 130%, creating a favorable environment for companies like ServiceNow that provide enterprise automation infrastructure. In terms of valuation, depending on the valuation methodology, ServiceNow intrinsic value generally ranges between 160 to $250 per share. From my analysis, I will put at the top end of the intrinsic value $270 per share. For investors who believe in the long-term growth of the enterprise and also the AI being continuing to grow, um, the recent decline with the April low may represent an opportunity to accumulate shares at a discount while the company continues to execute and grow. So these are my levels. I presented them in the previous video. So at a conservative level, around 160, and to a more speculative level at 270 is my intrinsic value, based on different methods of valuation and also on the market trending higher or speculating higher or having a premium upon companies like ServiceNow. Hope you guys liked it. See you the next time.